Great. Well, good morning, everyone, and welcome to the launch of the Global Financial Centers Index number 32. I can honestly say when we began this as a research project back in 2005, we had no idea whatsoever that this would become so influential, important, and interesting, if I may say. Today, a slightly different format. We're going to be talking with a number of people about new landscapes in global finance, prospects and responses, and we have a host of guests which we'll introduce in a moment. The agenda for today is fairly straightforward. I'm going to get out of the way as quickly as possible so we can see the results of GFCI 32, as we call it, Global Financial Centers Index 32. That'll be led by Mike Wardle and Yulin Chu, who's the Deputy Director of Financial Development at China Development Institute, which we often call CDI. Our friends in Shenzhen will also be presenting the results as well from the Chinese perspective. There is simultaneous translation going on. For those of you, please do click on the appropriate channel that you'd like to hear. After that, we're going to take remarks from four people: He Ping, Douglas McWilliams, Xian Zhongxin, and Yu Changhua, all of whom you can see here. And then we'll move into a panel discussion. You are heartily encouraged to send in comments, questions, and observations for the panel discussion, and I will try and feed your comments, questions, and observations into the discussion. But if I may, with no more ado, I'd like to hand the floor, if I could, over to Mike Wardle, who is head of indices here at Zien Group, who will be walking us through what has changed in the last 6 months in global financial centers around the world. Mike, the floor is yours.
Well, thank you very much, Michael, for that introduction. And the Global Financial Centers Index is part of Zien's Long Finance Program, research program, which intends to look at how we'd know our financial system was working. And we run a number of research projects as part of that program. The GFCI, the Global Financial Centers Index, is a factor assessment index, one of the indices we produce. These indices combine perception data with taken through a survey of finance professionals across the world with quantitative data, which uses advanced statistical modeling to combine those two sets of data. Essentially, what we look at is the correlation between a large number of quantitative measures, over 150 individual indices and data points for different aspects of performance, and the assessments given of the performance of financial centers by individuals through the survey. And we now are tracking 128 centers, of whom 119 are now included in the index, with 9 associate centers which haven't yet got enough interest across the world for us to rate in the main index. And really the history of the GFCI is moving from 46 centers when we first published the index, now to 119, with new centers coming into our orbit at all the time. And of course, when we first published this index in the 2000s, most of the European centers you can see in Western Europe would have been on the map, but a lot of the Asian centers that you can see here would not have been. And so really we've been tracking the rise of centers in Asia Pacific as we've gone forward. Just a word on who gets engaged with the GFCI in terms of the people who respond to our survey. First of all, by sector, you'll see there's a wide spread of people working in finance, professional services, banking, insurance, government and regulatory, etc. By region, Asia Pacific respondents are now well into the majority in terms of the people who respond to our survey. And so Asia Pacific remains a very important part of the financial world and very engaged with tracking what is happening. So to the results. The top 20 centers. First of all, New York, out in front, and is now well in front in terms of the rating, almost a 30-point lead over London in second place, which is, I'll come on to that in a minute. But really the messages overall is that North American centers, particularly US centers, continue to be very strong, no doubt reflecting their economy. And in terms of headlines, New York is not only in the lead, it's now been the lead over London for the last 4 years. Singapore has jumped into 3rd place in this edition, with Hong Kong in 4th position. And there's reasonable, however, stability in the rankings. Among the top 40 centres, only 3 centres rose 10 or more rank places, and there's reasonable stability in the ranking. But the overall average rating of centres in the index improved almost 5% compared with GFCI 31, which we published in March of this year. And they're regaining the kind of levels across the whole of the centres in the index we last saw in March 2020. This is interesting because, of course, there's a lot of talk about economic shocks at the moment, but there does seem to be improved confidence in financial centres themselves, even against that global instability. Paris returned to the top 10, replacing Tokyo, which fell quite a few points to 16th position. And there has been a lot of talk about a comparatively slow recovery following the pandemic. So we'll be tracking whether that rebounds as Tokyo starts to, as Japan starts to rebuild its growth. In the fintech ratings, which we publish alongside the main GFCI ratings, Chinese, US, and German centres performed well. But a number of other centres rose more than 10 ranked places, and we continue to track what's happening in fintech, which remains something which all financial centres across the world are putting a lot of focus into. The next slide shows an analysis where we take the top 5 centres in each region and show their average rating in the GFCI over time. And the message here is that North American centres just in the lead above Asia Pacific, with Western Europe coming in 3rd place, but all relatively close and tracking each other quite closely. The Middle East and Africa has had an uptick in this edition, so we'll watch to see whether that continues. And then Latin America and Eastern Europe coming a little way behind. And just looking at the top 5 centres, we can see here how close the competition is for 3rd place, with Singapore, Hong Kong, San Francisco almost rated identically. London just a bit ahead, but the real message here is that the gap in the rating between New York and London has become wider over the last few editions of the index, and we think there is a message in there about both New York's strength, but also about potentially London's position as well. Just on Western Europe and looking at the leading centres in Western Europe, we've mentioned London and Paris already, and in terms of order, Frankfurt, Amsterdam, Geneva, Luxembourg, Zurich, Munich. So a lot of the traditional centres, but also interesting that Munich and Berlin have moved into the top 10 in Western Europe, not traditionally maybe seen as one of the leading financial centres, but they appear to be coming up and performing particularly well. Looking at Asia Pacific, Singapore and Hong Kong we've spoken about, but also in the top 10 we have Shanghai, Beijing, Shenzhen, with Seoul at 11th, Sydney, Tokyo, Guangzhou, and Busan. And I think the 2 messages here are, first of all, the strength, continuing strength of Chinese centres, really making inroads. Secondly, the strength of South Korean centres, that Seoul and Busan, both in the top 10 in Asia Pacific, is a story, I think, in itself. North America, as I've mentioned, they are performing well. To have 3 centres in the top 10 from US, and then another 3 centres in the top 20 globally, shows really good performance. We do a couple of sub-analyses of the GFCI. First of all, looking at industry sectors. So here we take just the assessments in the survey from those people working in each of these industry sectors, and then we run it through the same model using the same quantitative measures. And you'll see there's quite a lot of difference here. New York, of course, and London do take leading positions across many of the industry subsectors. But I've just picked out, because we're talking with colleagues in Shenzhen today, we've picked out those areas where Shenzhen is performing much higher than it does in the overall index, where it is in 9th position. So people in banking and finance rate Shenzhen particularly highly. And there were messages here for financial centers as to their reputation amongst different parts of the industry, which are helpful for them in their development. We also run the index a different way, where we take each of the different areas of the quantitative measures. So we divide them into 5 areas of business environment, human capital, infrastructure, financial sector development, and reputational. And again, we run the model just with those quantitative measures. And again, New York and London come out first and second place on all of these areas. But you'll see other centers have particular strengths. Shenzhen comes out 3rd on financial sector development and comes up at 11th in infrastructure. Somewhere like San Francisco, Los Angeles, Seoul, all doing very well in human capital. So again, this is an intention, and you'll find more details in the published report. But this shows some of the strengths of particular centers and some of the areas where they could improve. And this allows us to undertake this kind of analysis, look at changes over time in center strengths. So this is taking a 3-year period from GFCI 26, published 3 years ago, to today's publication of GFCI 32, and showing the change in those 2 sub-indices ranking for Shenzhen. And you'll see on the areas of competitiveness, that's the groupings of the quantitative factors. It's improved, Shenzhen improved in all areas, not so much in human capital, but across business environment, infrastructure, financial sector development, and reputational areas. Shenzhen has improved its ranking against other centers quite considerably. On industry sectors, there's improvement in most areas, but actually a very stable position in the ranking on government and regulatory, and among those working in investment management. So again, useful to track change over time. I mentioned a little earlier the GFCI FinTech rating, and this gives a slightly different take on the strengths of financial centers. And you'll see that New York continues to take 1st place, with Californian centers in 2nd and 3rd place. London moved down to 4th for FinTech. Chinese centers again doing very well, with Shenzhen in 7th place on this measure. But really the message here is that Asia Pacific, particularly Chinese, and North American, particularly US centers, are performing very well. We asked in the survey this round a question about which factors are those that affect the choice of location for financial businesses. And these are the results. Quite interesting that the top 2 factors cited by people in the survey were access to customers, but second, a trusted legal and arbitration system, with openness of the economy and business costs coming 3rd and 4th. So, some interesting thoughts there for financial centers as they develop. They need to be able to offer access to customers, but they need a trusted legal and arbitration system and an open economy if they're going to be really attractive to businesses that want to locate in their region. And there's a bit more detail of that in the full report. I'm going to hand over now to Dr. Yu Lingxu to give a perspective on the GFCI from China.
好的，刚才我的英国同事也提到，全球金融中心指数的研究越来越有意思，有意思就体现在有越来越多的金融中心都在关注这个指数。那从中国来看，也可以看到有越来越多的中国的金融中心，包括深圳在内，非常关心我们 GFCI 的指数。我们认为，他们关注这个指数不仅仅是说关心排名情况，更在意的是，希望利用 GFCI 的评价体系，来对我们自身的金融中心的建设，作为一个后发性金融中心，应该如何发展，提供一些更多的启示。所以说， 基于越来越多的大中华区，特别是中国内地的金融中心进入到 GFCI 的排名体系，我们把相关的这个大中华地区的金融中心的表现进行评述，也希望能够带来更多的启示以及借鉴的意义更加的凸显。首先我还是想强调一下，刚才我们同事提到GFCI 的评价体系。我们用了评价模型，刚才说到一共用了150多个量化的指标，分别是从营商环境、从人力资本、从基础设施、金融业发展的水平、生意以及综合的因素来进行评价。这些指标全部来自于像世界银行、经济学人智库、经合组织、联合国类似的权威机构。同时也用了大量的问卷调查来更好的反映金融中心的未来的发展的潜力。比如说像最近的这 GFCI 第32期，就使用了一共有11000个金融从业人士的66000份的评价。下面我会展示一些具体的评价的结果。首先来看，其实我们看到一共有14个大中华地区的金融中心进入排名。那从这一期看到，得分是出现了一个恢复性的提高，就可以看到从疫情发生以来，整个得分和排名在下降的趋势已经明显的得到恢复。14个金融中心他们的得分全部出现上升，有些甚至达到了历史的最高值。这就反映出在疫情得到有效防控以及整个信心恢复的情况下，大中华地区的金融中心的竞争力是在不断的提升的。第二个方面也可以看到一些头部的金融中心，包括香港、上海、北京、深圳在内，他们的国际的排名和地位也是非常稳固的，都进入到前10名的行业中来。特别可喜的是看到一些后发性的金融中心，包括成都、青岛、大连、南京在内，可以看到他们的得分的上涨的幅度，甚至比香港、北京、上海、深圳这样的城市更高。所以说后发的中国的金融中心，它的赶超的趋势也是越来越明显。那第三方面，刚才我们同事也提到，各个金融中心都在布局这个金融科技的发展。那从前10名来看，中国的金融中心金融科技发展可以说是风头正劲。那从前10名的排名来看，中国一共有4个金融中心进入到前10名，在金融科技的专项排名中。另外也有可以看到，像美国也有5个金融中心进入这个排名。所以说在金融科技领域是一个趋势，就是中美两国的金融中心正在引领全球金融科技的发展，引领全球金融中心的创新以及竞争力的进一步提升。第4方面，我们也提到在调查中用了大量的调查问卷，我们把它叫做声誉的评价。如果我们用声誉的这个公式，就是说从问卷调查中的得分以最终得分的一个差距，显示了这个金融中心在国际上的声誉以及未来的发展潜力来看，可以看到从全球的评价来看，对中国的金融中心发展潜力是越来越看好的。很多城市，包括青岛、成都、深圳在内，他们的声誉的得分都是非常高，在国际上都是几乎在最前面。第5个是我们主要的中国的金融中心在不同的细分行业来看，都是得到了比较高的评价。比如说在银行业，深圳、北京和上海，还有在投资管理行业，北京、深圳、上海、广州、杭州等等。可以说在各个领域、各个细分的金融行业都有这些中国头部的金融中心进入到了行业的最前列，得到了越来越高的评价。那在最后，我提出2个小小的建议，可以让这些中国金融中心的建设者们可以去吸收借鉴，从我们 GFCI 的评价中获得更多的启示。第一个建议 是说要瞄准全球的最高标准，提升金融的营商环境。从评价体系来看，因为金融中心它不仅仅是硬实力，包括金融产业发展金融市场规模等等，还在于很多软实力的不断的提升，包括营商环境、一些城市基础设施、对人才的吸引力等等。那相对于纽约、伦敦、新加坡，也包括香港在内，这些全球最顶级的金融中心而言，我们中国的金融中心在更多的软环境建设上还是有比较明显的差距，未来还有更多的提升空间，从而增强我们的后发的潜力。第二个建议是，我们要进一步扩大金融中心的合作，来促进金融的开放和创新。从评价中也可以看到，很欣喜的看到，像成都、青岛、大连，他们在国际上获得声誉越来越高，得到了包括西欧、北美以及其他国际金融从业者的积极的评价。在中国的金融中心越来越走向世界的过程中，我们的金融中心就能够作为后起之秀，去学习先进的经验，去吸收和不断的集聚国际高端的资源，来提升我们的发展实力和竞争能力。我的介绍就这么多，我也非常期待后续演讲者的精彩发言，谢谢。
Well, thank you very much, Dr. Yulingju. It's a pleasure, as always, to work with our colleagues in the China Development Institute on the development and the delivery of the index. We're going to move now away from the GFCI results themselves. The report is published, it's available online if you go to zn.com, so you can follow that up later. We're now going to move on to a discussion about new landscapes in global finance, sort of prospects and responses. Michael Manelli introduced the speakers for this session a little bit earlier, but I will introduce them again. He Ping, the Deputy Dean of the School of Economics and Management at Qingdao University, Douglas Smith-Williams, Deputy Chairman of the Centre for Economics and Business Research, Zhang Zhongjin, Deputy Dean of the School of Finance at Renmin University of China, Yu Zhenghua, Professor of National School of Development at Peking University, and our own Professor Michael Manelli at ZEN. I'm going to ask each of the speakers in that order to take the floor for 5 to 10 minutes to give their thoughts on a range of questions around, what are the changes and challenges in global finance? Where's the solution in terms of global cooperation? What's the future of cooperation in financial markets? How to manage geopolitical conflict and the international challenges, and how countries might adopt energy supply policies. I invite actually our speakers to go wider than those questions as well, to give their thoughts simply about the global outlook for finance and for financial systems. So without any further ado, I'm going to ask He Ping to take the floor.
Thank you, Mike. And it's a great pleasure to be here. And I will mainly focus on the first question on the list. What are the new changes and challenges in the global finance in 2022? Probably I will make my speech a little bit more focused. So we all know that the international monetary system is featured with dollar and the euro as the major reserve currency and the international means of payment. And this actually generate all the patterns of the capital flow as well as cross-country investment. It also gives a lot of power for US monetary authority and Federal Reserve Board, the power to affect monetary policy in other countries. So the monetary policy of US dollar has an impact on the whole world, and the monetary policy of the other major economies are not fully independent. It also makes the dollar being the major currency to provide liquidity for the global financial system. Once there's a global financial crisis or instability occurs, then the US dollar assets become a safe harbor. All these being said, we say this is the pattern we have been familiar with over the past 40, 50 years. And however, I think with the COVID-19, there's some new issues coming out. And the first thing is because the COVID-19 actually increased the risk of industrial chain fracture. I mean, there are a lot of global value chain being broken because of COVID-19. Basically, COVID-19 is a shock to the global economy from the supply side. I would put a label on that. However, if you look at monetary policy globally, I mean, mainly, for example, US has tremendously increased money supply over the past 2-3 years with infinite supply, almost trillions of dollars, I mean, money supply increase. However, we all know that usually, of course, the money supply increase to some extent could actually smooth the market, install the market confidence to some extent of the financial market in particular. Also, another important feature of monetary policy is it usually increases a demand of the economy. For example, when you lower the interest rate or you increase money supply, sometimes it actually increases investment demand in the economy. However, we all know that the COVID-19 is not a demand side crisis. It's mainly a supply side crisis. You can imagine, even though monetary policy could restore some of the market confidence in the financial market, however, it can also bring inevitably inflation globally, because you can imagine when the supply side is not fully restored, and if you increase money supply to such a high level, then it will cause inflation pretty much everywhere, probably except China. I think China is doing relatively better in terms of inflation. Another problem we see also, another problem exposed by COVID-19 is that you see that actually the capital flow during the COVID-19 is actually inefficient, in the sense that we all know in 2020, actually US suffered the most serious hit by COVID-19. But actually you see dollar actually appreciate and the capital flow back to US. So you can, this kind of counterintuitive capital flow direction is actually consistent with the international monetary system, because US dollar is a major currency for international means of payment and reserve currency, as well as the US financial institution is actually dominating in the financial market, capital flow in the global financial market. So you can see these two actually improves the inefficiency of the old monetary system. And the reason that US can increase money supply to such a high level is because it can actually pass the cost of the inflation to other countries, because dollar has the purchase power of a global purchasing power. So it kind of pass out the part of the inflation to other countries. That's the reason. So you can see we are facing a very difficult situation right now, because with such a tremendously high level of money supply, it causing inflation as well as recession in some countries, even though US is doing relatively better in terms of economic performance, because if you look at employment data, it looks pretty good. Actually reach a new low level. So the unemployment is pretty good. So basically US actually have to raise up interest rate to kind of quench inflation. However, given its relatively better economic performance, however, it brings very high pressure for other economies, including China. Now, I mean, China is also doing relatively better than other countries, but we also experience a very fast capital outflow and the depreciation of RMB, and of course it could cause, possibly sometimes could cause market panics in other economies, in particular in small emerging economies. I think Europe and other major economies probably experience similar situation, because when US raise up interest rate in order to keep the capital flow stabilized, also to keep the exchange rate stabilized, you probably have to raise up interest rate as well but other economies not doing very well, in particular, given the Russia-Ukraine conflict. It has very asymmetric impact on the performance of the economies. For example, it has a much bigger negative impact on European economy, while it has negligible impact on US economy, possibly also negligible impact on Chinese economy. But it has a large impact on European countries. So given this kind of awkward situation, you can see raising up interest rate in Europe, even though, I mean, technically looks politically right because you have to stabilize the capital flow, but it actually is very, would possibly have a very strong negative impact on the economy. So we are facing this kind of very difficult situation because the asymmetric impact of the regional conflict, as well as the huge amount of money supply we expanded during the COVID-19. Now we are facing the question, we either choose hyperinflation or we choose a very negative impact on the economy, which will cause recession over the past 2 or 3 years. So I think that's the problems and the changes and challenges we are facing in 2022. So I haven't figured out a very good solution for that, but possibly having relatively more independent monetary policy across countries, and also we possibly should encourage US to adopt, to stop raising up interest rates so fast at the cost of the country's other major economies. Yeah, so that's all I want to share. Yeah, thank you.
Well, thank you very much for that opening contribution and a fascinating take. I'm now going to ask Douglas Smith-Williams to take the floor. Douglas, it's all yours.
Thank you. A few years ago, Britain was in the European exchange rate mechanism, and I remember visiting my friends at the Bundesbank and explaining to them that while the UK was in the exchange rate mechanism, German monetary policy had a much bigger impact on the UK than it had in Germany. And I think this rather echoes the point made by the previous speaker, that US monetary policy has a magnified impact in countries outside the US because of the status of the US in its in the world system of payments. Now, as I see the story in the US, what happened was that the economists kept on telling the Federal Reserve Board that inflation was temporary, it was a blip, it would fall back down. And it took quite a long time for the chairman to realize that what the economists were saying to him was wrong. Now, had Professor Ping He been advising the Fed, they obviously would have done a lot better. But they had advisors who seemed to think that you could have a massive monetary expansion. The money supply in the US expanded 20% in 1 month in April of 2020. You had a massive expansion of the money supply combined with massive fiscal stimulus as well. The idea that that would not have an inflationary impact against a major world supply side shock was, to me, rather absurd. And I can see that to my friends from China, it's also rather absurd. But the economists in the Federal Reserve Bank seem to think that there would be no inflationary impact. And actually, the economists working in central banks and treasuries in many other parts of the world seemed almost to be in denial about the impact. Once he was reconfirmed in office, Jerome Powell decided that he would follow a policy different from that recommended for his economists. And he decided his economists had lost credibility, and that if he, in his second term, was to be seen to be doing his job, he was going to have to deal with inflation. And as a result, we've seen they've almost got religion about reducing inflation. They've been putting up interest rates very sharply, and they did so even last night. And they've announced that they're going to continue to do so. They say we're just at the bottom of the range that might be restrictive, And I think that implies that we will go at least to the middle of that range and maybe even higher up. So we're moving into a world of much higher interest rates. Moving into a world of much higher interest rates means that policy is bound to be different. I'm not sure that savings and investment behavior at current rates of interest are hugely influenced directly by the rate of interest. Most people in business, if they're making an investment, they're looking for a return which is so much in excess of the market rate of interest that changes in the cost of money between 1% and 3%, or 1% and 4%, or even 1% and 5% probably don't change very much the nature of an investment decision in a world where things move so fast, you expect to get paid off in 5 years at most. I think that monetary policy now works mainly through its impact on asset prices. And I'm expecting to see the tightening of monetary policy worldwide, first from the United States, but then sympathetic moves from other countries as they try to keep up, having a major impact on asset prices, on the price of property, on the prices of stocks, and obviously it's already had its impact on bond prices. Now, you ask, what are the new challenges? Well, the biggest new challenge is going to be simply coping with this really quite abrupt and severe tightening of monetary policy, which has come as a result of monetary policy not being tightened nearly early enough. It should have been obvious by December 2020 that it was the right time to rein in monetary policy. It also should have been obvious that that was a good time to become less aggressive about fiscal expansion. The authorities did not do that. And so we are now paying for their errors of judgment. And the people who will pay most will be asset holders. And faced with what is certainly going to be a decline and might be a collapse in asset values, the financial system and the financial centers are going to have a really severe challenge. Their customers aren't going to be happy because they'll have lost money. They've had an easy ride so far because all you've had to do is hand your money over to people and the indices have all gone up. They're going to be going down. And as Paul Volcker, an earlier chairman of the Fed, said, when the tide goes out, that's when you discover who's wearing swimming trunks and who isn't. Well, I think the tide at the moment is going out. And I think if you look forward 2 or 3 years, you may find you get some very different comparative results for the ratings of financial centers. 2 final points. It's interesting looking from a UK perspective at what's happening to London and what's also happening to Edinburgh. Edinburgh, I'm a Scot, so I'm concerned about what's happening to Edinburgh. It's dropping quite sharply. And my guess is it's quite a lot to do with the behavior of the Scottish government. I think that they will have to try and become more pro-economic and less nationalistic. But that's their choice. They're going to have to make that decision. London is interesting. London's actually slightly closed the gap in the latest survey on New York. But of course, other financial centers have closed the gap on London very much more so. So San Francisco, Los Angeles, Hong Kong, and Singapore have all got very much closer to London. I think we in London, we in the UK, have to realize that now is not the time to be complacent. We need to make quite radical reforms to make our financial sector more competitive, to take away the attraction for just taking a turn on doing something fairly conventional, make people actually go and have to earn the relatively high salaries that they receive in the sector. If we don't make that change, we will gradually continue to slide down. So we have to do that. And finally, can I just congratulate my friends from Singapore? I was brought up in Malaysia, of which Singapore was at one point a part. and am very familiar with the operations of the Far East and Malaysia. I'm going there in a couple of weeks' time. And their achievement is stunning. And I think there are lessons for all of us in the way that the Singaporeans have run their economy, have managed things, and so on. And I would urge all of us around the world to look very carefully at the lessons from Singapore and see what we can learn. Thank you very much.
Well, thank you very much indeed, Douglas. Really interesting insights and linking obviously what's happening in the world economy to financial centres and the index results. Many thanks. So I'm going to now ask Zhang Zhongjin to take the floor, and I think I need to stop sharing my slides so that he can share his.
Okay, thanks. Thanks for the invitation, and nice to be here. My topic today is sovereign risk, inflation, and fiscal monetary policy coordination. So this brief overview of what I'm going to say. The world economic outlook is challenging. Sovereign risk and inflation limit fiscal and monetary policy space. Coordination is necessary, and there are things to do beyond monetary and fiscal policies. As everybody here knows, real activities started to slow down since the mid of last year. And at the same time, many countries experience very high inflation. Like in July, US CPI inflation reached 8.5, 9.8 in the UK, and 8.9 in the Euro area. And even in Japan, historically low inflation country, the CPI inflation reached 2.5. And also the inflation rate goes above 2.5 in China as well. So the challenging outlook requires policy actions. As Professor He Ping already said that this phenomenon looks like more caused by a supply shock. And in this supply shock, in my opinion, I think the most important is to protect the SMEs and the supply chain. And I will focus my discussion on that. Fiscal policies need to fill the demand gap and protect SMEs, both of which require money. Sovereign risk concerns may limit fiscal space. And also as my colleagues before has discussed, under high inflation, monetary policy faces a dilemma. Monetary stimulus not only increases inflation, but also poses a risk of capital flight when other economies hike interest rates. And however, high interest rate increases refinancing costs for government debt. It also reduces the scope of inflation to expand fiscal space. And as Douglas has just said, monetary policy also affects other assets such as stock and housing valuation, because right before the hike of the US Fed interest rate, many economies had some evaluation about financial stability, and many find that asset valuation was high. So interest rate movements will have real impact on asset valuation and therefore financial stability. So what's the current situation of sovereign risk? According to the OECD estimates, the central government marketable debt increased from 2000 to 2022 will be $13 trillion, which is a 1/3 increase from the pre-pandemic period. And there is risk of upward deviation from these estimates, particularly in the Euro area, and tighter monetary policy raises refinancing costs. This is particularly tight for the emerging market. Emerging markets and developing economies experience 74 credit rating downgrades. And we could see this also from the sovereign CDS spread, which is kind of insurance premium for sovereign bonds. As we could see, as beginning of the pandemic hit, sovereign risk in most developed economies surges. I didn't put Italy here because Italy's sovereign CDS spread was too high, and if I put it here, you cannot see this economies very clearly. But the trend was similar. And also, since the beginning of this year, due to the Russian-Ukraine conflict, the sovereign risk perception started to rise again. And similar situations exist in developing economies. Given under these circumstances, there is a very interesting discussion among many economists. Can inflation increase fiscal space? Because currently we have sovereign risk and also we have high inflation. Sounds like a double threat of a crisis, but can this kind of crisis offset each other a little bit? Actually, simple back of envelope calculations suggest that inflation helps reduce public debt burden. I remember that during the European sovereign credit risk crisis, there was a similar calculation by the Citigroup, and the bank claims that after the Second World War, about 50% of the debt was eliminated by inflation and financial repression, right? However, Helscher, Raviv, and Reis, they argue that inflation has very limited scope to reduce public debt burden for the following reasons. First, large increases in inflation are unlikely, and debt maturity is concentrated in the short end, and inflation persistence is low in the first few years. But these calculations were based on 2017 data, not seeing the high inflation scenario we face now. And interestingly, the same group of authors, they found a significant steady rise in 2021 in the risk of the persistent high US inflation and a sharp rise in 2022 in the Eurozone. Actually, those two charts are taken from the authors. They calculated the risk neutral distributions of US and Eurozone inflation from a 10-year horizon using inflation options. And as you could say, for example, in the US, before the mid-2021, inflation distribution was concentrated around 2%. But since the mid of last year, the mean start to shift rightward. And the tail, the right tail becomes much fatter, which means extremely high inflation becomes more likely. And similar situations exist in the Eurozone. And as a matter of interest, I run a panel regression using data from 2017 to September this year, and found out that the expected inflations have significant negative impact on the market perceived sovereign risk. For example, a 1% increase in the 1 year expected inflation will cut the sovereign CDS spread by more than nearly 4 basis points. And interestingly, the longer the horizon, the stronger the effect, which is contrary to the argument of the authors I mentioned before. And similarly, I also run a kind of impulse response analysis. Then you can find out that 1 standard deviation increase in the inflation expectation will cut the sovereign CDS spread on impact. So what should we do? Recall Eric Lieber's interesting result that fiscal and monetary policy should not be both active. So what I would say, somehow for many economies, from my perspective of protecting SMEs and the supply side, I would say keeping monetary policy robust while use fiscal policy actively. By robust, actually, Lieber didn't use robust, he used passive, right? But I prefer the word which is frequently cited by the Chinese central bank, robust. Like I interpreted this from two sides. On the one hand, we do not create exotic fluctuations in the interest rate, which help avoid the dilemma I mentioned for monetary policy before. And at the same time, provides necessary liquidity to SMEs to maintain the market liquidity and somehow protect the supply side. And then what active fiscal policy can do? Of course, everybody have noticed that many economies have adopted such policies to catch up demand loss due to social distancing policies. Second, avoid persistent supply loss by keeping SMEs alive and offset shocks to the supply chain. I think this is extremely important now. If we don't act to protect SMEs and the supply chain, the transitory supply shock will become permanent. I think that will have presently bad impact on inflation. And third, if possible, properly use redistribution policies. And I will discuss this in more detail in 1 minute. And fourth, also importantly, distinguish between and coordinate long-term and short-term targets. Especially those emerging market economies should carefully coordinate the industry policies targeting long-run goals. Well, there could be many long-run goals, such as the ESG, which is quite cited often nowadays, like environmental, social responsibility, and governance. But we have to be careful about those long-run goals, although those are noble and important. But we have to remember Keynes' famous saying that in the long run, we're all dead. So I think we have to coordinate these policies to avoid unintended side effects to slow down the economy in the short run. So, and I think there's one thing we could do beyond fiscal and monetary policy. So both the COVID-19 shock and the commodity price shock have asymmetric impacts on different industries. So some proper risk-sharing design could help smooth the impacts on real economies without increasing government leverage. So fiscal redistribution is just one way to do that. But with proper institutional arrangements, I believe the financial market could also do the job. The first from negatively hit industries could issue bonds, while first from positively hit industries buy the bonds. The repayment scheme could be designed to help those temporarily hit good first keep necessary cash flows to survive, while generate attractive return for investors in the long run. From a dynamic perspective, this could be Pareto. And the government could promote such market by providing information for the identification of goods but unluckily hit first and financing support for the investment. I think compared to a fiscal redistribution policy, this kind of design have two advantages. On the one hand, it could be politically more feasible. On the other hand, it could make better use of dispersed information in the industry because it sort of combine the information from the government and also from the industry. So I think due to time limit, I think that's what I would like to say. Thanks for your attention.
Well, thank you very much indeed for that analysis and for looking at the various responses that might be appropriate at the present. I'm now going to pass on to Yu Changhua, Professor of National School Development at Peking University. The floor is yours, Dr. Yu.
Thank you, Mike. And I would like to thank China Development Institute and the Jing Group for holding such an interesting dialogue. And it's my great pleasure to share my thoughts on global economy today. First of all, I'll present some standard facts about the global economy and some bilateral investment relationships between the European countries and China. And the last part are present some challenges and some policy recommendations. So first of all, let's review some standard facts in the global economy, which have already talked by Professor He and Professor Qian and Douglas. So we know that over the past few years, particularly after the COVID-19 pandemics and there are massive monetary and fiscal stimulus in world economies. For instance, if you look at the benefit of Federal Reserve banks, and after the onset of the COVID-19 pandemic, and its benefit doubled before the COVID-19 crisis. So at the same time, we see that the dollar exchange rate against advanced economy currency and also emerging market economies. If you look at this US dollar index, we see that the US dollar exchange rate becomes stronger since 2015, and over the last the period 5 years of period. We know that we experienced the U.S.-China trade conflict and the following COVID-19 crisis. We see extremely volatile exchange rate movement between the dollar and the other currencies, both in advanced economy and in emerging market economy currencies, particularly due to the Russia-Ukraine war. We see that advanced economies, particularly for the euro, depreciated a lot against the US dollar, and for emerging markets, their currencies also depreciated a lot. And due to the adverse supply side effect, for instance, the direction of global supply chains and other type of disruptions, and also due to the massive fiscal and monetary expansions and the inflation spikes in advanced economies. For instance, the inflation reached to 110% in European countries, and also 7% in US. And in order to fight the high inflation, the Federal Reserve of banks in the United States and also the ECB increased their interest rate a lot. And we also expect that the Fed and the ECB will continue to increase their loan interest rate to drive down domestic inflation. So a key question here is that what will emerging market do? Whether that from the historic evidence, whether that when US and also ECB move their interest rates dramatically, and there will be dramatic capital flows across borders. So what will emerging market do? So for emerging markets, so they face a kind of trade-off or dilemma for monetary policy. For instance, on the one hand, we know that in a lower interest rate or expansionary monetary policy could encourage domestic aggregate demand and push up the domestic output. But on the other hand, lower interest rates also may lead to domestic exchange rate depreciation. So an expectation of domestic currency expectation lead to capital outflows to other countries. So this may cause domestic non-exchange rate depreciation. So historical evidence showed that usually when the core country in international market raise their interest rate, and the peripheral countries, both advanced economy and emerging markets, should also tighten monetary policy as well in order to stabilize their inflation. But we know that the high interest rate will depress domestic output. So what will emerging market do? So we may need other policy instruments. For instance, we may need a capital flow management in emerging market economy. So they use the capital flow management to control volatile, to reduce the volatile capital flows across borders and stabilize the exchange rate. Then, conditional on this tighter capital flow management, domestic monetary authority could expand their space of expansionary monetary policy. So in this case, they could use independent domestic monetary policy and capital controls to deal with domestic demand and stabilize the exchange rate. And over the last 2 years, we see a volatile capital flows across borders. One new phenomenon is that we can see that since the onset of the COVID-19 crisis, China's current account becomes surplus. So it's around 2% of GDP of current account surplus, and also the Eurozone maintains a relative moderate current account surplus around 3% of GDP. But if you look at the current account to GDP ratio in the United States, it became more active than before the onset of the COVID-19 crisis. So a lateral question may arise in this situation is that so this kind of capital flows or global imbalance is sustainable. So what can we do? Well, what do this economy do after the pandemic crisis? If we, for instance, if we look at forward in a couple of years, and what can we do? So this may reach the traditional concerns on global imbalances. Okay, this is the first part, and the second part are show some facts and some thoughts on the China-Europe bilateral direct investment. So I show two numbers. So the first one is about direct investment. And this figure shows you that the China's direct investment in the rest of the world, in other countries, including United States and four countries in Europe. And we can see that the blue bars shows China's direct investment. The inward direct investment means the investment from foreign countries. We can see that China has attracted millions of direct investment from both from United States and also from some poor European countries, particularly from Germany. But if you look at the orange bars, so the orange bars show the China's direct investment in these foreign countries. We can see that in the States, so the orange bar is quite similar to the blue bar, which means China's direct investment in the States is comparable to US direct investment in China in terms of scale. But if we compare the blue bars and the orange bars in the core European countries, we see that there is a huge asymmetric capital flows for direct investment, which means France, Germany, UK, and Italy put a lot of development investment assets in China, but the China direct investment in these four countries are very small. So this is kind of an imbalance of direct investment between China and Europe. And also, if we look at the portfolio investment between China and the core Europe countries, we see that first for the top panel shows you the portfolio investment from three core European countries: Germany, France, and Italy in China. And roughly speaking, we can see the ratio of portfolio investment in these three countries in China increased a little bit. But if we look at the absolute numbers, so the number is extremely small, almost close to 0.4 percentage point. But if we look at the bottom figure, it shows the China portfolio investment asset in Germany, France, Italy. So the orange bar shows that this ratio is quite stable over time. of course, if you look at the blue line shows the portfolio, China's portfolio investment assets in the United States. So we can see a dramatic decline of this ratio. This means China's portfolio investment assets are placed in many countries rather than the US alone. So you can't like the international risk sharing for China's investors. Okay, to wrap up, I think there are two things or two respects we have to pay attention to. The first one about the policy spillovers, particularly in response to tightening monetary policy in advanced economy. So the emerging market should use different policy instruments, for instance, the capital controls to regulate monetary capital flows and also stabilize exchange rate, and then release the hands of monetary authority, and the monetary authority then takes independent monetary policy, for instance, expansion of monetary policy in emerging market to boost up aggregate demand. So in this case, the emerging market economy could stabilize the domestic economy and also exchange rates. That's the first one. And the second one is about the balanced financial position between China and Europe in the medium and long run. So we see that there are huge asymmetric financial positions, both for direct investment and portfolio investment. So I think that there is a huge potential for Chinese investors to invest in Europe, as long as there are for instance, the Europe provides a more fair and more competitive environment for Chinese firms to play in the European market. Okay, that's what I have, and thank you very much.
Well, thank you very much indeed for that. We're now going to go to our last speaker today in the panel. So over to you, Professor Michael Manelli. I'm just finding the slides.
Okay. Well, thank you very much, Mike, and it's really an honor to be here with such a distinguished panel and so international. I really appreciated the presentations of everyone, especially our Chinese colleagues. We're running a bit over time, so I'm going to keep my remarks probably a bit terser than I'd anticipated, but I feel it is important to remark probably on three things. And you'll remember that Charles Dickens had a tale of two cities. Well, this is, I think, in many ways here in GFCI 32, a tale of three cities. And I'd just like to draw three out because I think each of those three exemplify a particular theme that I believe is running through what we've been seeing. The first city I'd like us to focus on is San Francisco. Now, San Francisco has moved up over the years to fifth position. In fact, it rose 2 slots just in this edition. Why is that important? Well, when this began, and we even had San Francisco on the various slides and shows, people used to laugh. They were kind of, what's San Francisco as a financial center? A little bit of insurance, a little bit of asset management, but certainly not a major center. But if you'll look here, you'll see that both San Francisco and Los Angeles, i.e. the West Coast, California, are extremely strong contenders. And what does that show us? Well, I think it shows us bluntly the importance of IT, information technology. It's been this IT revolution, which has quietly been powering things. When Mike was presenting the results of GFCI, he indicated in one of his slides that people were less interested in whether or not the workforce did or didn't have significant language capabilities. But here it's very clear that what people want is programming language capabilities. So we may need to alter that, I think, in the way that we ask the questions. The second city I'd like to point out is Seoul. Seoul is risen 1 rank, but is actually very strong at 11th. So we're looking at an economy roughly 2/3, half the size of Japan's. Seoul is well ahead of Seoul is well ahead of Tokyo at 16th. And of course, in Seoul, we also have a smaller twin in Busan. Why is Korea doing so well? Well, I think what Korea has done over the 20 years that I've been working with them, 25, has been it's become a much, much more open economy, a much, much more open society. It is extremely easy to set up a business in Korea. And of course, we've had the benefit of K-culture, K-pop. Those of you who are on Netflix are inundated, as I am, with Korean drama, much of which is very interesting and good. Korea has completely transformed from being an isolated rural community or an isolated industrial community to being an open, global, exciting cultural partner, and has benefited from many of the movements in the Asian region, particularly from Hong Kong. The third city I'd like to pick out is Sydney. Sydney is the rising star here, jumped up 10 entire slots in one go. What's going on at 13th? Well, arguably, Australia should have been much more of a powerhouse anyway, particularly with its commodities-based economy, huge amounts of exports, etc. But I believe what we're seeing here is an emphasis on green. As Australia begins to enter the green finance area, we're seeing that people see this as something that could be much more exciting. So the 3 cities I picked out, San Francisco, I think exemplifies tech. Seoul exemplifies the importance of having an opening and welcoming culture. And Sydney exemplifies the rising importance of green. And in many combinations, we see those as 3 competitive themes. The second area we've been asked to comment on is what's going on in global geopolitics, particularly with regard to supply chains. I would just simply make the observation that increased competition and globalization had driven many companies to get all of the fat out of their system effectively. And in removing all of the fat out of the system, these supply chains became brittle. We saw this brittleness during the pandemic, whether it was to do with semiconductors or various other supplies and shipping. But we also saw it due to the Ukrainian conflict, Russia's invasion. Obviously, companies around the world are working, and we are working with them, on how do they estimate the amount of fat that they should have in the system. Too much fat and they're uncompetitive, too little and they're too brittle. But this is actually, oddly, in financial centers terms, good news. This means that we're going to have more complex supply chains, that they're going to be more automated, and therefore that there will be many, many more transactions. I think people who examine financial centers, in my opinion, spend too much time looking at stock exchange trading volumes or the importance of capital, both of which are clearly important to building a financial center. But when we talk about a financial center actually connecting with the real economy, what we're talking about there at the very start is trade. It's no coincidence that financial centers are typically ports or huge junctions of railways or highways. That's actually what begins things. The capital and the high volume transaction, financial exchange trading comes later. And I think what we're looking at here is perhaps a boom for financial centers, whilst arguably the world economy is going through transitions, cost of living crises, and energy trading issues that are not good. So we may be somewhat counter-cyclical as financial centers in that regard. So those are the 2 points I wanted to make, but I believe we've got a few comments and questions. Well, we've got one question here from Bob McDowell, who's dialing in from the Channel Islands. Bob is curious if people believe that there's been does the current survey disclose any rise in political risk in the United States? Is this a socially and politically divided country? I was wondering, Doug, would you mind having a stab at that?
I'm probably the least qualified to do so, but I don't know what I don't know the details of the survey because I've just seen the survey results for the first time during this presentation. But I think rather than just talk about the United States, I'd like to talk about the world. I think if you look at the front pages of the two major newspapers in the UK, we're talking about the risk of nuclear war. I still think these risks are quite low. But if people are worried about nuclear war, that really is something that is a game changer. It doesn't actually matter how much money you've got if you're about to be blown up. I mean, you know, you've got bigger priorities. And so I genuinely think that the first priority for all of us needs to be to try and get a level of cooperation between the United States and China especially, that makes it possible for some of the major international areas of tension to be resolved. Because we can't go on just ratcheting up and hoping we get lucky. One day we won't get lucky, and one day that will mean something pretty disastrous. Now, in terms of the internal politics of the United States, I quite agree that the United States has appeared to become much more divisive, but it's a trend that's spreading to Europe, and it looks even more obvious if you spend a bit of time on social media, where people seem to be in entrenched positions and making quite bizarre comments about people who've got different points of view and so on. It just seems to me that people need to step back. They need to realize that other points of view can also have a degree of validity. We need just to stop thinking that we're the only people whose views count for anything. And if we can do that, with a little bit of luck, we might resolve some of the issues in the United States, but much more importantly, resolve some of the issues between different countries in the world. Because if we carry on the way we're doing, the future could be disastrous.
Well, thank you, Doug. We have a question here from Francis Chung, and I've taken the liberty of asking Ping He if he might want to comment on this. Francis's question is, Singapore has been rising quickly, coming neck and neck with Hong Kong for third place. Do the panel think Singapore will take over from Hong Kong as the international financial hub in Asia? And if Ping, if you would like to answer that, and then I'd be very happy to equally have comments from Zhongxing or Changhua.
Thank you for asking. And this is an interesting question. I think it really depends the future relationship, I mean, political relationship between China and the US. As I mentioned in my speech, as I said, US dollar is a major currency for reserve as well as for international means of payment. It actually gives the power of US government as well as financial institutions to have a huge impact on capital flow globally. So I would think that the recent rise of Singapore has political forces behind it, because you can imagine Hong Kong has some issues going on that kind of actually on which actually US and China has a very divided opinion towards that. And so in the future, I think if a political relationship between China and the US getting better, I think Hong Kong will still remain the major international financial harbor in Asia. But if it turns out that the US and China split up further, and I would think that the capital outflow will possibly actually continue to flow out of Hong Kong and flow into Singapore and making Singapore international financial harbor in Asia. But after saying that, there are other possibilities, because as I said, the old international monetary system or the order could be changed because COVID-19, as well as because of Russia-Ukraine conflict. And in the future, the capital flow, the impact of US on international capital flow could be weaker. So again, and there are other possibilities, and other factors could possibly affect this. But over the short run, I would think that the US-China relationship will be a determinant factor for that. All right, thank you.
Very interesting. Well, thank you. I think it's an excellent observation. In many ways, that's what's destabilized it. We've got a very interesting question from Hugh Purser, very on the topic of supply chains. Hugh is asking, there is much discussion of rebuilding supply chains on a domestic or trusted regional basis and shifting away from the global model, which has turned out to be so fragile. How big could this shift be? And any thoughts on how it will affect the role of financial centers? Changhua, I don't know if you might like to open. I think your slides touched on this to some degree. If you wanted to come off mute, that would be super. Thank you. Did you have some thoughts on the supply chains shifting to trusted regional basis, and how big could that shift be in your opinion?
I'm not sorry about it. So I'm not expert on global supply chains. So so if you look at the data, as a matter of fact, in the China's international trade with the rest world actually increased over the past the 2 years. So which means even though there is a COVID-19 crisis in China, so international trade still stays at a historical high level. This one thing, and we also know that international trade is linked with international the cross-border invoicing and settlements of goods and services, and so that if you look at the trade data and also the invoice of currency of RMB, renminbi in the international market, as a matter of fact, the RMB invoicing share stays at a high level. So it's quite competitive in international market. So if we look at maybe 5 years or 10 years later, I believe the faster growing of China's economy, so international trade, the trade balance, or sorry, the import plus export to GDP ratio, this is so-called trade inflation will continue to grow in the next few years, I believe. So which means the Chinese market will be a very important market to the rest world. And Professor Ping mentioned that yes, the US dollar is the dominant currency in the current international financial system, and RMB only occupied a tiny fraction of, for instance, the currency shares in international market. But the RMB share is rising. It continues rising and may overtake, for instance, the Japanese yen in the near future. Thanks.
Thank you. That's absolutely excellent. And it interestingly leads in a ways to another question from the audience. And I was wondering, Zhongxing, this might be one for you. Do you see the current geopolitical environment acting as a spur to further de-dollarization? It was interesting that last week, The Economist had a very, very lengthy piece on where the the e-renminbi, or they call it the ECNY, is headed. We've obviously seen the hegemony of the dollar yet again, influencing the way that prices are going, and also that move that we traditionally see when crisis hits, which is the dollar rises and all other currencies tighten. But do you think that this current geopolitical environment is going to be a spur to further de-dollarization, or do you feel that we've seen this before and we'll just do the same again?
Thanks, Michael. I think actually it's kind of a very interesting question. Actually, in May, I made a public speech in Chinese for similar topic in China. Actually, I think after the Russia-Ukraine conflicts, actually we see quite a few changes in the sort of global financial landscape. I think this also the proper answer to this question also depends a little bit on the question we discussed before, like the diffusion of public opinion on many issues nationally, because this has something to do with the interpretation of quite some sanctions from the European and US side on Russia in these circumstances. Because from a sovereign risk perspective, like if you have a breach of the contract, that could increase the probability that you could default in the future to other economies, right? But that somehow depends on the potential investors' interpretation of the breach of contract. So that depends on people's value. Like if people think that kind of sanction is from for some kind of understandable reasons, then the investor might not be so affected. Like the subjective evaluation of the sovereign bonds default probability will not be so significantly affected. But from the other hand, if people interpret that from a different way, like once you default, that means you have a history of breached contract, and those kind of different way of interpretation will have a profound impact on that. And what we observe in the past few months all over the world, we could somehow see the difference, right? Like we see quite a few economists or like governments announced some kind of proposed plan to build their own financial infrastructure and diversify their international investment position. And also people started to discuss their national financial security. That's a signal that at least part of the potential investors is worried. And we see actually already from my slides, like the sovereign, perceived sovereign risk rise significantly since the start of the war in January. So somehow how this will evolve depends on our answer to the previous questions, like how the division of opinions in different national economies evolve. But somehow this thing is also very endogenous, because I think the division in people's political opinion also depends on how the economy performs. Because I studied in Europe, and when I was there, the financial crisis in 2008 just started, and you could see how political opinions around you evolve because of the change of the economic situation. So this thing is kind of complex, but somehow I would say there's a lot of uncertainty around this, and we see already some impact from the past few months of some nations' reaction to the Russia-Ukraine conflicts and the followed up sanctions from different countries.
Well, thank you very much for that thorough response, really helpful. Well, folks, we've come to the end of our 90 minutes. And in closing, may I say a few things. Firstly, the full report is available online, as will be the presentation, and the recording will be up hopefully later today. There are news articles already appearing around the world, and it is interesting to see at this time of change that financial centers appear to be strengthening as the world itself, as our panel has shown, is showing some elements of stress and strain. I hope that you've enjoyed today's presentation, and please do join me in thanking our 5 panelists who walked us through some interesting thoughts on new landscapes in global finance. So it's Heaping from Tsinghua, Doug McWilliams from the Center for Economics and Business Research, Chen Zhongqing from Renmin in the University of China, Yu Changhua from Peking University, and also, of course, our own Mike Wardle, head of indices, who's brought us together today to have this very interesting conversation. The index is online, as you see here in front of you, and if you would like to participate as a professional working in a global financial center, please feel free to go and take the survey. It's a continuous survey running throughout the year. And that is, I'm afraid, all we have time for. My thanks to all of you in the audience for coming and listening, and we'll see where things move in another 6 months. Thank you very much.